If you can think back to the beginning of 2022, you might remember the global economy looked a little different than it does today.
The mood was very fraught. It was a very difficult time for people who pay a lot of attention to the U.S. economy and the global economy.
That's Closer reporter Ben Walsh.
In the U.S., employment was really strong. There had been a huge snapback from early pandemic job losses. Wages were rolling. Workers were doing great. But throughout 2021 and into 2022,
inflation is still running hot. This is the fastest consumer inflation, the fastest rate of price increases we've seen for just about everything since February 1982. The headline number for you...
Inflation is taking a big bite out of Americans' everyday budgets and savings.
The worst inflation that the U.S. had seen in several decades.
Gas prices are hitting records just as AAA's national average price for a gallon of regular gas is $4.32.
And a huge part of that was the price of oil and the price of gas, relatedly at the pump, was going up and up and up.
Topping off the tank, now taking a bigger bite out of the budget as prices at the pump continue to climb. This sticker shock in downtown LA, $6.21 a gallon.
And as February 2022 rolls around, not only does it look like there's no end in sight for those trends, but things actually look like they could be getting worse because Vladimir Putin is threatening to invade Ukraine.
After months of increasing tension between Russia and Ukraine, on an early February morning in Moscow, Russian President Vladimir Putin makes a televised speech.
He's basically laying out the rationale, such as he sees it, for the invasion of Ukraine, which, of course, he euphemistically calls a special military operation. So he's announcing that Russia, in his view, has been forced to take special military operation against Ukraine in order to support the predominantly Russian sympathizing parts of Ukraine that are in the eastern part of the country.
Russia has launched what U.S. officials describe as the most significant military action in Europe in 77 years. Russia has attacked Ukraine with airstrikes, missiles, and troops.
And pretty much as soon as he does this, global commodities markets, especially the oil market, go completely haywire.
The price of oil smashing through $100 a barrel for Brent crude, which is the international benchmark for oil prices.
Russia is a huge, huge producer of oil and natural gas. And people were really, really worried about what would happen if that oil went offline as the U.S. and other places put sanctions on Russia.
Now, meanwhile, Ben, there's an economic policy guy here in the U.S. watching all of this unfold.
My name is Skanda Amarnath. I am the Executive Director of Employ America.
What's going through Skanda's mind as he's listening to Putin's speech?
Yeah, so the important thing to understand about Skanda and the think tank that he runs is that he cares a lot about ensuring that there are more jobs in the U.S. rather than less jobs, which sounds like kind of an obvious thing. But in the wonky world of U.S. economic policy and the Federal Reserve, he's very focused on making sure that the Federal Reserve supports what they call full employment. And a lot of the Federal Reserve's efforts, especially in February 22, are focused on fighting inflation, which is the other thing that the Fed is supposed to be worried about. And so Skanda is out there looking for ways that we can fight inflation while not just raising interest rates. And then he's watching Vladimir Putin give this speech.
The revelation of that moment was we're going to be hit with a set of shocks that our only policy answer that seems likely to come is the notion that the Fed will hike interest rates even faster.
Not only is there a huge and devastating war coming, but he realizes that the world is in for a very significant supply shock in the energy markets.
The truth of the matter is the U.S. government does not have a detailed, elaborate policy toolkit for dealing with supply shocks, even of the most conventional kind.
And so Skanda thought, what if the U.S. government gets into the oil business?
Last year, the U.S. government did get into the oil business, and it did so after Skanda Amarnath proposed a radical policy idea to try to save American jobs. This is The Closer, a show about how deals change the world. I'm Amy Keene. On this episode, how an economic policy researcher convinced the White House to strike a deal on oil. Ben, let's start with some background. Tell me a bit about who Skanda Amarnath is and how he became such a significant voice in D.C. on the U.S. labor market.
If you had to create the platonic ideal of an econ wonk, you would probably come up with Skanda. He is extremely precise in the way that he thinks and talks about things. He is incredibly knowledgeable and is also very reserved in terms of what he feels qualified to kind of expound on. He is younger, and he hasn't gone through sort of multiple tours in Democratic administrations like a lot of people have in the econ wonk world. And so he's a bit of an outsider, but he definitely has influence and people pay close attention to him.
Including economic policymakers in the White House and in other branches of government. One thing they pay close attention to him for is understanding how certain policy decisions could affect jobs. And in this period of quickly rising inflation in early 2022, there's some very relevant monetary policy at play. The Federal Reserve is signaling it will begin raising interest rates, all in an effort to tame rising prices.
And what he's worried about is that inflation is rising at this moment. Oil is a huge part of the inflationary story.
So Skanda's thinking the Federal Reserve is already planning to raise interest rates, but will it raise these rates even more than already planned in order to deal with the effect of oil prices?
And the point of raising those interest rates is basically to slow the economy so that inflation comes down. But what often happens is that the Federal Reserve hikes rates, and causes a recession. Millions of people lose their jobs. They don't have as much money to spend. Inflation comes down. And in a sense, the Fed looks at that historically and says, mission accomplished. Inflation went down. Obviously, not paying as much attention or putting as much weight on the other side of that equation, which is that millions of people lost their jobs.
Now, Federal Reserve policy was one really important thing to think about. But there were shifts in the oil market that Skanda was also paying attention to. For the latter half of the 20th century, the U.S. had relied on importing oil for its energy needs. But about a decade ago, American production of oil and gas increased dramatically thanks to a process called fracking, or hydraulic fracturing. And by 2018, the U.S. had become the largest producer of oil in the world.
And so in terms of what someone in D.C. might call energy security, there's a lot that you can do domestically that you couldn't do 15, 20, 30, 40 years ago.
But unlike some of the other big oil-producing countries, the U.S. was still limited in how much it could do to influence prices.
There's no national U.S. oil company that Biden appoints the CEO of. In the U.S., it's a whole bunch of different kind of fractured private enterprises that interact with policy that Washington, D.C. sets. There's no energy minister that you can call and say, open the spigot.
But Skanda had noticed a change in how the U.S. oil producers in this vast private industry were managing investment. Usually, when oil prices went up, you'd expect investment to also go up. And when oil prices went down, investment would fall.
It's not a Newtonian law, but it is like pretty good as far as economic relationships go. But what we had noticed in 2021 and 22 was that was looking less elastic. Yes, maybe there's that same relationship's true, but not as much. Oil prices can go up a lot. Investment doesn't really move as much. And not only that, you're hearing it from the oil companies and their CEOs very directly. We are going to be disciplined about investment.
Oil executives are scared. And what they're worried about is they know the price of oil is high now, but they are terrified that the price of oil is going to drop at any moment. And they're worried about that because they've seen it happen several times in the last decade.
We had an epic crash from triple-digit oil prices down to about 25. That took place over 18 months or so. That was a big money-losing proposition for a lot of producers.
Now, if you look at where the individual pain has been felt within the energy sector, first of all, talk about exploration and production, right? These are the guys that extract oil out of the ground and then put it out in the marketplace.
But even after that washout, we got a mini crash in 2018-19. That also proved to be a sort of chilling moment at a time when everyone thought oil prices would sort of be on the mend. And then we got negative oil prices in 2020.
US prices of oil due for delivery next month plunged yesterday to minus $38.
Oil prices go up and up and up, and they invest a whole bunch of money in new wells and new production, thinking that the price of oil is going to stay high, and then the rug gets pulled out from under them, and they and their investors, importantly, lose a bunch of money. And so what the CEOs were saying at this time is, listen, Wall Street, our investors are saying, be cautious, don't increase investment to increase production. We're not going to pour money down the drain like we did the last couple of times when oil went high and then crashed. We're going to exercise what they call capital discipline because our investors are demanding it. And so Skanda thought that coupled with the fact that these CEOs controlled in aggregate the largest oil producer in the world, he thought that the solution could be there.
The solution to oil supply, and therefore prices in the US, could lie somewhere in the way oil executives were thinking about investing in production.
So let's think about why it makes sense for them and figure out how to change the financial incentives that they're responding to. And what he figured out was that oil executives and their investors were super sensitive to what people in financial markets would call downside risk.
So when I talk about downside risk, what I'm really referring to the fact is that exploration and production companies are highly exposed to the price of oil. And so it's really the downside risk to the price of oil and how that affects profitability.
So sure, oil's at $110 a barrel now, but there's a 15% chance it could be $40 a barrel in 8 months. So why am I going to take out a whole bunch of loans and sink a bunch of money into drilling new wells when I could lose money on those wells that I'm drilling now, because when they come online, oil's going to be half the price it is now. And so there are lots of ways that oil executives respond to that downside fear. They hedge and they enter into all kinds of financial contracts, including futures contracts, like any commodities market, to try to deal with that uncertainty.
If you have certainty about the downside, maybe you'll even be willing to finance the transaction, you and whoever is financing you. So that's the real opportunity.
This is where Skanda comes up with a kind of radical idea.
The radical idea is, what if the U.S. government committed to buying oil at a price that was profitable for oil companies to produce it at? What if the U.S. government gets into the oil business? Well, part of the answer is that the U.S. is already kind of in the oil business in a very particular and peculiar way through something called the Strategic Petroleum Reserve.
It's below ground storage that can hold crude oil for long periods of time.
And that is the U.S. government's emergency stockpile of oil.
It's a stock of crude oil or a stock of crude oil storage capacity. But what we really honed in is it's actually not straightforward to store crude oil over long periods of time. And the SPR is pretty unique in the fact that it can do that.
And it exists so that in the case of a natural disaster or some kind of emergency, that there's some large amount of oil that the U.S. government controls and can pump into the market.
It's a pretty interesting and important tool when you think about how big the SPR actually is.
It holds a little over 700 million barrels of oil, which seems like a huge amount, but that's only enough to get the U.S. through 35 days or something of oil consumption. It's not that much, actually. And you can only release something like 4 to 5 million barrels a day out of it because of literal physical limits to how much oil can come out of the caves that it's stored in.
It's a supply of oil that U.S. presidents have tapped for emergencies since the early 90s.
So what Skanda realized is that people had only been thinking about the oil in the reserve as the asset. But what he realized is that what the Strategic Petroleum Reserve has that no private entity has in the U.S. oil market is the ability to store millions and millions of barrels of oil for a very long time.
The value of the storage capacity is itself important. Vacant storage can fill future barrels of production in the event of another glut. And if you can provide that kind of contingent commitment, that should be pretty valuable to industry.
What Skanda realized is that as you release oil from the reserve, you create empty space, storage capacity, and that the storage capacity could be an asset that could be used to help stabilize U.S. oil markets and to incentivize U.S. oil companies to produce more.
So the U.S. has the oil reserve that it can tap to boost the supply in the market. I get that. But what Skanda is saying, this new idea, the new part of the idea, is that in having that spare storage capacity, the White House could actually promise or guarantee or say that it'll buy oil back from producers at a future date to replenish those stores. Is that how this would work?
Yeah, so everyone knows that at some point they're going to refill the reserves, and that means the U.S. government is going to buy oil. But no one kind of really has a good idea of when it is or what prices will be. So Skanda's idea is, let's tell everyone that we are going to buy back oil at prices that support U.S. oil production and basically say, hey, oil producers, we've got space in the Strategic Petroleum Reserve and it's got your name on it at this price level. And the U.S. government can do that using futures contracts, which are a crucial part of the U.S. oil market and the global oil market. And so his core idea was the U.S. releases oil when prices are high, which is already sort of de facto U.S. policy. And then at the same time that it's releasing the oil, it says we're going to buy back oil when prices are lower. Not when prices are rock bottom, $20 a barrel, and the U.S. oil industry is going through serial bankruptcies, but lower. And that will give the U.S. oil industry confidence that it can sell oil at a profit in the future.
This was the plan Skanda carefully came up with after seeing oil prices skyrocket when Russia invaded Ukraine. He thought if oil prices could be managed to some degree, maybe the Federal Reserve wouldn't feel the need to raise interest rates so high and so quickly that Americans risked losing their jobs. But now Skanda had to convince the folks in charge of the U.S.'s emergency oil reserves, and that bit of deal-making took him right to the White House. We'll be back after the break. So Skanda comes up with this proposal. It's a very new way of thinking about how to manage this particular moment of potential crisis that Skanda sees coming. But I want to try to understand how, somebody sitting in a DC think tank office actually goes about influencing policy. So he prepares this paper, ultimately, this argument. It's my understanding that he actually shares it with the White House before it's officially published. Can you just take us through what happened once he got the idea and actually put it to paper? How did he then start to share it?
Yeah, so he's developing the policy and he's talking to people in the White House about the policy. It's a very common tactic among DC policymakers to sort of have a combination, what they call inside-outside strategy. So you're having private meetings, you're preparing memos and presentations that outline the policy that you want. And at the same time, you have a think tank, and so you publish a public version of the policy that you're talking to people about in private. And you talk to journalists about it. You talk to other people in the oil industry or whatever industry the policy relates to. You talk to people, not just in the White House, but on Capitol Hill. Skanda went and talked to members of Congress. But importantly, this policy doesn't require a new law. You can do it under existing authority. And so you kind of have this inside-outside, back and forth, push-pull.
I think the people who were most convinced and most persuaded were probably in the National Economic Council.
This is the group of White House staffers who advise the president, in this case Joe Biden, on economic policy.
I think they had a pretty deep appreciation of both its political relevance and, hey, there is like a real production supply-demand challenge that's like brewing or looms large. And so we better have some good answers here.
And a lot of it is related to giving the people inside the administration who maybe support or are sympathetic to this idea the information and the kind of ammunition that they need to convince internal skeptics that this is a good idea. And it's important to say that this policy did have its skeptics and critics.
I think there were a lot of people who were skeptical. I think a lot of people were skeptical first of the releases, of the SPR releases having any effect. Then it became, well, could we even do anything here with the purchases? They're really a drop in the bucket. Can they really do any market stabilization? Isn't that what OPEC is for? Which is like, it's true, OPEC can do things that the U.S. can't do. That's true. But it's not as if the U.S. can do nothing.
There are some economists who are so-called inflation hawks. They're very committed to the idea that monetary policy is how you fight inflation and that the Fed should raise rates even if it means risking a recession. And there are some Democrats and environmental activists who think President Biden shouldn't be in the business of helping oil companies make money.
And I think it's kind of important to sort of hone in on that because we're talking about the Biden administration here. It's very focused on reducing U.S. greenhouse gas emissions, reducing oil consumption. And then you have this guy from kind of the leftish wing of the Democratic Party who's like, you could say critically, he wants to help oil companies. Why do we want to help oil companies? That's not what the Biden administration exists to do. And so it's a very touchy and delicate process. And then beyond the White House, the Strategic Petroleum Reserve is under the control of the Department of Energy, and the people who run it at the DOE are career DOE employees who don't really care about the peculiarities of the Biden administration's political problems. Their job is to run the Strategic Petroleum Reserve and dramatically changing how the reserve is managed and creating this kind of new financial mechanism around it is quite radical. And so there's a lot of institutional inertia that is arrayed against this kind of policy.
So Skanda sort of quietly shares this idea with a number of different, you could call them stakeholders, some people in the White House, especially some of the economic thinkers in the White House, people on Capitol Hill, probably on background with some journalists. But then the paper itself actually gets published, and there's a lot of press around the paper itself.
Joining us now is Skanda Amarnath. He's the executive director of Employ America, and he's out with an interesting new plan in order to take on the gas price crisis. An actually useful, actionable report here on what exactly the Biden administration can do via executive order. Skanda, thank you so much for
giving us the very high-level idea here of how the White House can use the Strategic Petroleum Reserve strategically to ease oil markets right now.
The tools we've laid out are really about addressing.
So rather than try to fix this crisis with more cash, I think we ought to try to solve it with more capacity. That brings us to our guest, Skanda Amarnath.
Skanda's proposal comes out in early March 2022. Later that month, the White House separately announces its own decision to release 180 million barrels of oil from the Strategic Petroleum Reserve. It's a massive release of 1 million barrels a day for 6 months in order to try to boost supply.
The March release that you're talking about was very much in keeping with how previous White Houses had dealt with the reserve. Prices go up, you release some oil, and that's kind of what you do. And you hope that the markets react in a positive way and prices come down.
But that big oil release was only half of the policy Skanda crafted. He wanted to fundamentally restructure how the White House refilled the reserve. And he spends the next few months advocating for this part of the policy.
But the real moment when I could figure out that it actually had deeper traction and not just hints of traction was when we found out that they were going to change regulations based on it.
That change would allow the Energy Department to pay a fixed price for oil delivered in the future, rather than relying on the present market price. Skanda's analysis showed that if the oil industry knew the U.S. government would buy oil at certain prices, the industry would produce more oil, and in turn, oil prices would come down. And in May, Skanda got his first real indication that the Biden administration was warming to his proposal.
And they reached out to us to say, hey, that your particular idea and thought leadership was the key catalyst I'm pretty sure it was the key catalyst. I think we're the ones who are most nerdy about this stuff, but our ability to draw attention and to design a policy like this was what motivated the change in regulation in the first place.
And then finally, in October of 2022, the White House comes out and says,
"Today I'm announcing 3 critical steps that my administration will take to reduce gas prices at the pump."
They release more oil from the emergency reserve.
President Biden announcing a move aimed at lowering high gas prices, releasing 15 million barrels of oil from the Strategic Petroleum Reserve.
And that they will also, in a future date, buy back oil at a price range of between $67 and $72 a barrel or lower.
The United States government is going to purchase oil to refill the Strategic Petroleum Reserve when prices fall to $70 a barrel.
And that's huge. And they also release a couple of small policy changes to sort of help some supply chain issues in the oil industry. But the big thing is that's Skanda's policy. Release oil when it's high, buy it back when it's lower. That is a lower price than what was in the market when the policy was announced, but it's not rock bottom. It's not $25 a barrel. It's not $30 a barrel. It's a price where the oil industry can look at it and say, we can work with that. And it's also a price that's high enough that it's not necessarily going to incentivize the creation of new gas guzzlers from the U.S. auto industry.
It's a signal of support to the market without overdoing it.
It's a signal of support to the market without overdoing it. So the policy is announced in October 2022, and they do the first half of it. They release the oil, but you still got to buy it back. And they also had to implement the policy by actually buying back the oil, which meant futures contracts, which meant a kind of a new way of the DOE operating. And so it was a little bit rough going.
Rough going to get the policy off the ground. And because Biden's move sparked a wave of pushback from political rivals and right-wing pundits.
But how substantial of a move is it? I know it's historic and they're touting it that way, but when you look at the shortfall in the market, how much does this really help?
What is your response to Republicans who say you are only doing this SPR release to help Democrats in the midterms?
Joe Biden also said this is not politically motivated. Now, obviously, it is politically motivated. That is the reason why they're tapping the Strategic Petroleum Reserve.
His decision to drain our strategic petroleum reserves to salvage a few votes is putting our country's national security at risk.
And then in the summer of 2023, they finally got it, and they bought back an initial relatively small amount of oil that is just a fraction of how much they've released. But it's a proof of concept, and what it shows is that, the DOE is in the oil market, and it's in the oil market in a very specific way that is helping to ensure some kind of price certainty, or at least lower uncertainty for U.S. oil companies.
To step back a little bit from that direct goal of managing oil prices, what's the bigger impact of this policy that has now been implemented and has now been in play for a bit of time?
Yeah, well, so the big impacts that you can see, which is that the amount that U.S. oil companies are saying they're going to invest in new production has gone up dramatically since the policy was announced, while oil prices have gone down. So that's a huge kind of shift that's really positive. And then the other thing that's happened after the policy was announced, remember we talked about downside risk and how oil companies are obsessed with that, and they enter into all kinds of financial contracts to insure against a drop in oil prices. The price that oil companies pay for that insurance in financial markets has declined significantly since the policy was announced. So the volatility in oil markets that people are expecting, as measured in these financial contracts, has gone down dramatically. Investment is way up, and prices are down to where they were before the Russia-Ukraine war. So it's a good outcome overall.
We should note that in the last couple of weeks, oil prices have inched higher amid the conflict between Israel and Hamas. And I suppose the jury is somewhat still out on what this means politically, how people actually feel about the price of oil, which is such a key part of the Biden administration's interest in doing this policy.
And this policy is not the only thing going on in the oil market. You have OPEC with its own concerns and production decisions. So there's lots of things influencing the price at the pump beyond just this one policy. And so it's not like the US government now has complete control over oil prices or gas prices, but
it's a much bigger player.
It's a much bigger player. And as Skanda said, the government is developing the muscle, and it wasn't there before. And it's kind of a situation of it's now started the habit of going to the gym, and it's only going to get stronger from here.
As for Skanda, successfully taking a policy from his office to the White House was a lesson in deal-making itself.
This probably is as true for government as it's true for any bureaucracy, including corporate bureaucracy, is people are really risk-averse, and they want answers for what happens in worst-case scenario. And so there's a lot of institutional risk aversion, too. I think it's very hard to break that status quo, even if you have good ideas, unless you fully appreciate, empathize with why, more frontline decision makers generally tend to stick to the status quo. That risk aversion runs deep, and I don't think it's even that has a certain rationality to it. It's important to understand if you want to change policy, if you want to set a different course.
That's all for this week's episode. But coming soon to Brazen Plus, hear more from Skanda on why he, as someone primarily focused on U.S. jobs, got so interested in oil prices. The Closer is a production of Project Brazen in partnership with PRX. Our show is produced by Isabel Kirby-McGowan, Trina Menino, and Jay Venables. Ben Walsh is our reporter, Mariangel Gonzalez is our project manager, and Lucy Woods is head of research. Macon Dean is programming manager, and Ryan Ho is design lead. Golda Arthur is our showrunner, and Bradley Hope and Tom Wright are executive producers. Our marketing consultant is Maggie Taylor, and I'm Amy Keene. Thanks for listening.